coin that wants to be decentralized as its only value, otherwise it's a glorified barcode. Its only value is riding anonymously along this blockchain. And then they say, okay, well, now I want Wall Street's blessing. Well, when they do that, all of the value of it goes away. So count me out when it comes to cryptocurrencies. So for years and years and years, the Fed was trying, they were vying to bring about this nirvana of 2% inflation. Well, they couldn't get there because they have no idea what causes inflation. Market's down 30% in 2 weeks, very, very likely. Repo market freezes, no more junk bond issuance. And Powell goes, okay, sorry, I was bluffing. I really don't think we're raising interest rates and we're going back into QE. So
hello, everyone, and welcome to Risk. My name is Lee, and I have a phenomenal guest with me, Mr. Michael Pento. Michael, how you been?
I've been fine, Lee, and thanks for having me on your program.
So I'm sure you have not been bored. The markets have been quite interesting the past few weeks. Why don't you tell us a little bit about your background, how long you've been at this, and what you've seen in that time?
I hate to admit it, I've been at this game for 31 years, yes. And I've seen bubble after bubble pop. And it's my opinion that these iterations between deflation and inflation are happening more frequently and with greater intensity. And I don't think that changes. But yes, a little bit of my background. I've worked on the floor of New York Stock Exchange. I've worked for discount brokers, retail brokers. I was a senior economist for 2 firms, and then I started my own shop in 2012. And the predicate for my firm is the inflation, deflation, and economic cycle model, which I created myself over these past decades. I launched it officially in 2015 or 2016. And like all good models, it's always updating, it's always improving, always getting better. Like one of the big flaws in the model was it didn't understand how to trade gold, but now it understands how to trade gold. And believe me, and maybe you'll understand this and your listeners understand this, and gold could be euphoric and excruciating. It could rip your heart out and destroy your performance. You have to know what really drives the price of gold. So the model is 20 components and it's plugged into a diffusion index. The diffusion index spits out a number and puts it on an investment spectrum between deflation and depression and hyperinflation or stagflation in those 5 sectors, that spectrum. And then, you in this way, you always know, the goal is to always know where to invest your money. What style factors, high beta, low beta. What sectors? Do you want to own utilities or do you want to own banks? And what asset classes? Do you want to own commodities? Do you want to own money? Like gold is money. Do you want to own that? Do you want to own bonds? You want what currencies you want to own and when? So that's the predicate of the model. But most importantly, Lee, is the model is built to ensure that you can ride asset bubbles as safely as possible, but most importantly, understand when to get off of the bubble train and short the market. Because we intend on, my Pento portfolio strategies intends on trying to, best we can, capitalize from what I call this great reconciliation of asset prices, which is coming.
Do you see a future where we have massive deflation in asset prices, but massive inflation in consumer goods?
Great question. I mean, I never really put it that way. So what I do see is inflation that we've just heard about today, which is from the Bureau of Labor Statistics, 6.8% consumer price inflation. Let's talk a little bit about inflation. First of all, you should understand.
Hold on, before you get into that, do you actually believe that number?
No, I think it's way higher, but you should also understand in the context that 6.8% inflation is 3.4 times higher than the Fed's own asinine 2% target. First, the Fed 1913 says we're here to make sure that we have stable prices. The dollar never goes down, it never goes up. The prices are stable. You don't depreciate your standard of living. You don't destroy the middle class. Zero inflation. Somehow through the decades, it became known, especially in the wake of the great financial crisis, 0% inflation is actually deadly to an economy. You can't run an economy on 0% inflation. Never mind the fact that we had the greatest economy, the greatest country the world has ever seen. The Industrial Revolution was built on disinflation.
Yep.
So now it's 2% inflation. So for years and years and years, the Fed was trying, they were vying to bring about this nirvana of 2% inflation. Well, they couldn't get there because they have no idea what causes inflation. They're looking at Phillips curve stuff. They're looking at this like wage. What in the world, Lee, is a wage price spiral? And when has it ever happened in the world, in the history of the United States or in the world? There's such thing as a wage price spiral. Like all of a sudden, all the workers demand more money and then the employers are forced to pay them more money. And then they ask for more money. The employees ask for more money, and then the employer, and where's all this money coming from, Lee? Nobody knows. The wage price, this is what happened in Austria, don't you know? And in Weimar, Germany, and in Zimbabwe. It was a wage price.
And it's happening in Turkey right now, and Yeah.
It's not the fact that Erdogan and his band of his carousel of central bankers, he just switches them out until he finds the best puppet for him to destroy the lira. So inflation, as we know, comes from destroying the confidence in the currency, and you do that by printing too much money. Well, the Fed for a long time just destroyed what it did was printed a lot of money, and what it did was create inflation on Wall Street. So they figured out if I just print a bunch of money and hand it to the primary dealers, the bankers and on Wall Street, what I won't get is consumer price inflation, at least the way they measure it. What you'll get a whole heck of a lot of is what? You'll have inflation in asset prices. Mm-hmm. So they're sitting here like they created the biggest bubble in fixed income in the history of mankind, another huge bubble in real estate, another humongous bubble in the stock market, but they're still wandering around in like 2019 saying, oh, gee, where's the inflation and the consumer price level? Then comes the pandemic, the global pandemic. And then I guess they stumbled on the truth. Well, if you really want consumer price inflation, print up $6 trillion and hand it to consumers, which is what they did. So now we have consumer price inflation, 6.8%, the highest since 1982. And we also have concurrently a massive bubble in those three assets. They haven't gone away.
No.
And the reconciliation of those asset prices, which is coming very soon, we're switching from inflation to disinflation in Q1 to deflation, in my model's view, in Q2. So here it is, Lee. While the Fed and the merry band of money printers at the FOMC suddenly had the epiphany, like last week, they have the epiphany that, inflation is not transitory, and we're now going to start to accelerate and expedite the tapering of its $120 billion a month per month, each and every month asset purchase program. They suddenly have this epiphany, but they're reaching it years too late. They should have been tapering these asset purchases and ending them a long time ago. So now we have a very hawkish, all of a sudden, the watershed moment came for Jerome Powell. He probably got the 6.8% CPI print ahead of time. So now he's like, oh my gosh, we're going to have to accelerate this taper. That'll be probably announced on Wednesday of next week. But he's doing it at it's way too late. He's doing it now just as the headline inflation has peaked and economic growth has peaked. So he's going to be tightening into a disinflation and deflationary environment, which will cause, and the Fed will once again prick the asset bubble and send asset prices crash.
They've been doing this over and over again, and your average person out there just really doesn't know what's going on. They don't follow this. But I'm going to assume that the people at the Fed know exactly what's going on. They know that they're causing this, and they're doing it intentionally. Do you think it's that, or do you think they're just really stupid, or just they don't want to be the guy that is known for pricking the bubble?
I think they're feckless, incompetent, reckless, dangerous. I really can't get in the minds of these people. Paul Volcker was the last great Fed head that we had. They have to know on some visceral level that it's not a wage price spiral that causes inflation. They have to know that it's hay. And this has to be, hopefully this is going through the head of Jerome Powell. I expanded the balance sheet from $800 billion, not him, but him and Bernanke. I expanded the balance sheet from $800 billion in 2007 to $8.5 trillion today. That's base money supply growth, which is the foundation, the building blocks of every other monetary aggregate, M1, M2, and M3. So, bank loans and, time deposits. They have to understand that if you increase the money supply from 800 billion, the base money supply, just the base, to $8.5 trillion, that maybe you have shaken the confidence in the purchasing power of the U.S. dollar. Do you think if they're listening to Lee, if you think they're listening to this risk, do you think that's an epiphany for them? I just find it hard to believe that they're just that freaking stupid. Maybe they are.
Yeah, maybe. So let's get into your investment style. I know you manage a portfolio and you're somewhat of a hedge fund because you go long and short. You touch different assets. How do you control your risk in your portfolio?
So what I do is I look at the second derivative, the rate of change of growth and inflation with an emphasis on inflation, and I invest accordingly. So if I see a shift, which I have identified, the model has identified through its 20 very carefully and rigorously back-tested components, I find out what the macroeconomic condition, the direction of, in the rate of change basis of inflation and growth is going to be. And when it looks like growth is slowing and inflation on the second derivative basis is slowing, which I believe will be the case in Q1 of 22 and especially Q2 of 22, I start to change the portfolio from being long banks, being long base metals, being long energy, being long yield curve expanders to the opposite. So I start getting long things that work well when the yield curve starts to shrink. That 210 spread shrinks when the yield curve is about to invert. So I'm looking more of bond and bond-like proxies at this moment. Very defensive. I also, because of the announcement next Wednesday, which will be the FOMC meeting for December, when Jerome Powell comes out and avows this expedited taper from $15 billion a month to $30 billion a month, and winds down purchases completely by March, I believe that could rattle the markets a little bit. So I have taken on 2 short-term hedges against the falling market.
Are you taking options on the VIX?
Outright shorts. No, so I don't use in my portfolio. This is a widow and orphans portfolio.
Okay.
I mostly invest for people who have already made a lot of money, and they're not interested in using options, margin, or leverage, and neither am I. We want to preserve our wealth, grow it in a real after-tax basis while bubbles inflate. We're not looking for 50% returns. So we have a very, very low standard of deviation in the portfolio, very high Sharpe ratio. And what we're looking for is to just participate in these bubbles safely, but more importantly, protect and profit potentially from the great reconciliation of asset prices, which I think begins sometime around the second quarter of next year. That's my best estimate based on the data and math that I look at.
We've had the World Economic Forum talking about the Great Reset for quite some time. I mean, they know the game is up, and it's exactly what you're saying with the great reconciliation of asset prices.
Lee, here's the thing. So people often say, and rightfully so, well, Michael, why can't the Fed just look at the stock market and when it starts to fall, just change course and say we're going to go back into QE? And that's been the modus operandi for decades now, Lee, right? So every time the stock market had a hiccup, the Fed came to the rescue. Well, the only thing different this time is that now we have jumped the shark with inflation. So if you have 6.8% year-over-year inflation, the way they measure it, if you want to measure it pre-Boskin Commission, maybe the way they used to do in the 80s, we're talking about mid-teens, Lee.
Yeah,
in reality, I mean, you're looking at 20%. Home prices up 20% year over year. Bacon prices, meat prices, I can go on and on, but you car prices, used car, airline fees,
Yeah, and the average person is actually feeling inflation now. I mean, if you go back to 1987, when the plunge protection team was born back then, and then we had it expanded under Greenspan, and they've been able to get away with this rigged game without people feeling inflation, but people are feeling the inflation now.
Because why? Because what was the main difference between now?
What you said earlier.
Yeah. It's you paid people $6 trillion to sit home and not produce goods and services. They had all this buying power, but nothing to buy. So too much money chasing too few goods causes this 20%, 15, 20%, depending on how you measure it and who you are. Every person's inflation rate is different. You send someone to college, you have college-age kids, the drill. But that's what they did. So here's the thing. Here's what I think about. I think about Japan 1989 and China 2007. Both those very big economies. Okay, so China is arguably first or second in the world. Japan is very close to number 3, I think. Big economies. So I'm not talking about some banana republic. These big economies, their markets have gone nowhere for decades. In the case of Japan, for the past 30 plus years, they're still not back to that high watermark in nominal terms. Forget about inflation adjusted. So here's the problem. Here's what I think about. What if the Fed in, let's just say, pick a month next year, a probable month, May of next year, April, May of next year, says, oh my God, I've completed the taper. The taper has been consummated. I've now threatened and I've telegraphed that the first rate hike is coming. And the dot plot shows that we're going to have 2 or 3 more hikes this year, followed by more hikes next year. Think about like 2019, when the repo market froze and the credit markets froze, and they happen again. So the stock market's down 30% in 2 weeks, very, very likely. Repo market freezes, no more junk bond issuance, and Powell goes, okay, sorry, I was bluffing. I really don't think we're raising interest rates, and we're going back into QE. So here's the way I think about things. Is that good news or is it bad news? Because the whole predicate for these very elevated asset prices, Lee, is low interest rates. Well, if you then tell the bond market, you tell holders of treasuries, both domestic and foreign, that, well, we're not going to be able to support our currency and we are going to inflate you to oblivion if you own our treasuries in US dollars, what does that do to the yield on long duration sovereign debt and that convexity where you go out, further you go out, the more problems you have with inflation. So I think it could be a really big issue.
So you're projecting a flattening of the yield curve coming up soon.
First, predicted it. I've been on record saying it. It's exactly what's happening. And a flattening of the yield curve, perhaps an inversion by Q2 of next year, or very close to that. You have growth and inflation rapidly decelerating, some kind of problem in the stock market, junk bond market, credit markets. And then after that, does the Fed ameliorate the problems just by going back into QE when you've told the world, you've told all your investors that, look, we're never going to be able to drain our balance sheet. We're never going to be able to fight inflation. We're never going to be able to defend the value of our currency. And I'm not talking about the currency against the euro. Now, I've been long dollars and very successful. I'm not talking about other flawed fiat currencies. I'm talking about how do you defend the dollar against oil and energy?
Yeah.
And Lee, where does inflation go and how fast does it get there when the Fed and the Treasury, which, by the way, you look at Janet Yellen, there's no wall.
Yeah, there's no wall at all.
There's no wall. So, you know what happened, and we just talked about Turkey. So when Erdogan, or whoever's in charge of the United States, the Erdogan, calls Janet Yellen and Jerome Powell into the White House and says, we are now going to borrow into existence trillions of dollars that you're going to print, and we're going to hand it out in some form of helicopter money, universal basic income. You're going to have, I don't think inflation stops at 6.8% or 15% or 20%. We could look a lot like Rome, the world's reserve currency, but inflation's 1,000%.
I just had a conversation with Dr. Mark Faber, and he was such a bear on bonds. I mean, it sounds like you're in the same camp.
I am bullish on bonds short term. Longer term, I'm very bearish. I mean, come on. I mean, how could you think about this, Lee? This is how crazy things are. How could you have a Fed's balance sheet at $8.5 trillion? How could you have inflation running at 6.8% the way the Fed measures it, the way the Bureau of Labor Statistics measure it, the way the Department of Labor measures it? How could you possibly have that 6.8% inflation and a 1.4% 10-year note?
Yeah, it doesn't make any sense at all. You're basically losing money every and significant amount.
You're getting crushed. You're getting destroyed. Someday it'll wreck the currency too, maybe even against the renminbi. So I don't know if that ever happens. Actually, the dollar is losing ground. Maybe the foreign creditors say, hey, I'm getting killed in the currency I hold, and I'm getting killed in inflation. Like, what are you doing? Why am I here? Why am I storing my surpluses with you?
It doesn't make sense for the future auctions of treasuries.
Nope. And that means that you might have, and it's not a call. This is a very difficult call to make. I'm just saying, I'm going to be cognizant of it. I'll model it. I'll observe it. But if we have a spike in yields, I'll look at things like the MOVE index. It's mostly short-term volatility of bonds, but I'll look at other things that tell me, wait a second, the bond market now is signaling that yields are going to be spiking, inexorably. And what does that do to the valuation of equities? Sitting here at 206%, the valuation of market cap of equities, 206% of the underlying economy. Lee, that has never happened, not even close to ever happening before. If you look at the apex in 1929 or 2000 and 2007, we're not even close. There's never been anywhere near so overvalued. And that's the metric I love to look at, that and price to sales, because you can't fake that. You can't go out and issue a bunch of debt, buy back your shares, increase your earnings per share, and drag down that PE ratio, which is still 21. So
yeah, it's all synthetic. Now, let's talk a little bit about the systemic risk, because I know you've talked about ETFs. I mean, we have all these funds. I talked to Dave Cranswell last week, and he pointed out that Kathy Wood's ARK is invested in a lot of thinly traded stocks. So,
I just wrote about this, Lee. I just wrote about it.
Okay.
Yeah. So Kathy Wood has this disruptor ETF, and I'm not disparaging Kathy Woods. I mean, she's making a buck and she's doing very well. But this is why I have my model. So what style factors do you want to invest in when the growth rate of earnings is going to crash from 45% in 21 to like 5%? Hopefully, in 22. When the GDP growth crashes from high single digits to 3% in 22, from 21 to 22. Well, the one thing you don't want to own is companies that have extremely high PE ratios or no PE ratios, because they have no earnings. The companies that have no real sales yet, theoretical, companies that might do well in the future, or they have very, nominal sales. When the price to sales ratio is 100, you might be a disruptor. But listen, this is the worst thing that you want to own when the economy is rapidly slowing and inflation is waxing from rapid inflation to disinflation and deflation. These things, these highly speculative, high beta companies will get destroyed. And by the way, that's my theory. That's how I invested. I don't own any. She has 45 component listings in her ARK ETF. Before this week started, every one but two was down 20%. Two of her components were down 80%.
Wow.
Okay. I don't want that in my widows and orphans.
No, I don't think anyone wants that in any kind of portfolio unless they're on the other side of that trade.
No, but I heard Kathy Woods the other day talking about her team of analysts think that she's going to return. This is her, not me. She predicts that she's going to return 40% annualized over the next decade. First of all, I think it's illegal. I could never make a prediction like that.
Yeah.
But she said she believes. I guess it's legal for her, not for me. I'm a fiduciary, and
Well, she's buying and promoting the right things, Michael.
Well, you have to own the right things. This is the monolithic zeitgeist of Pento portfolio strategies. We want to safely ride this bubble higher, as I said, safely ride this bubble higher with hedges and be able to profit potentially from this great reconciliation, because it could be as much as 80%. I'll just say this to you. 80% sound like a Cassandra, but in 2000 to 2002, the NASDAQ lost 83% of its value. The S&P 500 lost 50% of its value. And there was nothing anybody could do about it.
I think it's much worse now because of what you said in other interviews where everyone's in these ETFs. I mean, to unwind those positions is going to be a nightmare.
That's what, see, this is why, first of all, I've been saying, can we just back up? Lee, you're a genius. I love being interviewed by you because you're so knowledgeable. So that's just and I believe, and I only speak from my heart. That is a great way of looking at this. See, the correlations go to 1. What does that mean? Everything's going to go down because you say, well, Apple's going to have a car in a few years, and Apple low PE ratio stock, lower than Kathy Wood's stuff. So I'll just own quality when the poop hits the fan. Well, no, every ETF owns Apple and Microsoft, and everybody's going to be selling these ETFs at once. And when the selling begets selling, because then you have the redemption of these units, these creation units, you got to sell the underlying. And every single everything in the ETF gets sold, which begets more selling in the ETFs. It's all interconnected. So when everything goes to an R squared, a correlation of 1, so your foreign stocks, your Apples, your domestics, your small caps, your big caps, your low vol, your high vol, everything goes, your utilities, everything goes down.
Right. Even mining stocks.
Especially precious metals mining, even gold goes down.
Yep,
So here's the thing. And I'm only here to make my clients money. That's my primary goal. So I don't care where that takes me. I love gold. It's the only real and honest money we have. And there are times you have to be massive long of it. There are times you should get the hell out of the way. So what do you want to own? There's only 4 things you want to own when you have a liquidity crisis, because everything else gets dumped. This could happen next year by the second quarter, by the way.
Your 4 horsemen, right?
Yeah, 4 horsemen. You want to hear them or you know them? Right?
No, you can say them. Go ahead.
You go. You. Let me see if you know them. Go ahead.
Cash, right? Short-term bonds. I forgot the other 2. I'm sorry.
The dollar.
The dollar,
U.S.
right.
dollar, because the dollar is one of the heavily carry traded currencies. So people borrow in dollars and go overseas and buy a whole bunch of other bonds and stocks. And then when the poop hits the fan globally, what do they have to do? They have to close out that transaction. So they sell what they own overseas, buy back dollars.
I mean, this is basically a classic flight to quality is what you're talking about.
Flight to quality. And that's why the yen rallies. So people say, what the hell? Why in the world would the yen be a flight to quality? No, it's the closeout of a carry trade. That's why the yen rallies. So the dollar will only lose ground against the yen, but it'll go up against the euro and Mexican peso and real and all the other currencies. And the other thing, most important of the 4th horseman, is to short the stock market. You have to be able to know when to short the stock market.
Sorry, you mentioned earlier that you don't do margin or options. How are you going to go short in your fund?
So I even try to avoid inverse ETFs, but I will short the junk bond market using SJB. So that's a short junk bond, but that's the daily inverse. So here's what you can't do. You can't say, I don't need to be with Michael Pento. I'll just buy SJB. Well, you're going to lose half of your money waiting for this junk bond market.
Yeah. But believe me, I've been there. I've experienced that firsthand. So.
Well, I don't do that. So when my model tells me it's time to short, I'll buy SJB. But I also have ETFs that you could go long, and they do the shorting for them in a type 3 margin account. They pick the sectors and the companies to short. You go long them, and they will go up in price as these underlying issues go down. And they take the risk as far as shorting using the type 3 and margin. I don't do that. So that's how, and by the way, these ETFs that I'm referring to from Dorsey Wright, these ETFs are not subject to that daily reset.
Yeah.
where it's just a death by 1,000 cuts.
Yeah, it could be painful to be in some of those things too long a term.
Well, yeah, absolutely. But again, if you short junk bonds, if you use these non-leveraged ETFs that aren't negative inverse, and if you own cash and you own short-term treasuries, you'll do a lot better.
Yeah, I'm sure.
A lot better than you would have done. Like just look at August 2008 or January, February of 2020 to see what I'm talking about. There's no place to hide.
No,
But those.
yep, absolutely. Everything goes down at once. So all ships sink. So let's add to this systemic risk puzzle here. What are your thoughts on cryptocurrency and what I see as a bigger bubble than the tech bubble?
Oh, you do? Oh, okay. All right. Wasn't sure how you felt about crypto. It's not gold 2.0. It really irks me when people say that. So what makes gold valuable is that, when stars exploded and they made the element AU and they put it in the Earth's crust, there's a limited supply of gold. And as you dig deeper and deeper, it's more, difficult to mine. It takes a lot more human capital and energy to pull an ounce of gold out of the ground. So maybe like, $1,500 an ounce. So there's a floor to what the price of gold is. Well, it's the same with Bitcoin. Only the electricity used to mine Bitcoin might be about the same, maybe $1,500 an hour per unit, but it's $47,000 per token right now in the case of Bitcoin. So, how do you value something like that? Plus, gold is limited in supply. There's 21 million units of Bitcoin, but wait a second. How many Bitcoins are there that perform essentially the same function, which is moving a token along a blockchain? Well, there's 1,000 blockchains, and there's unlimited number of cryptocurrencies that can be created, which perform the same function, moving a coin anonymously and in a decentralized manner, immutably, supposedly, along the blockchain. So it's not limited in supply, can never be gold 2.0. Then you say, well, there's a lot of value to being able to move a coin decentralized in a decentralized fashion, in other words, away from the banking system, so nobody knows who you are. There's a value to that, and I'll agree with you. Some value, a few $100, maybe a few $1,000 a unit, maybe, but not 65,000, because in order to justify that price, Lee, this decentralized coin is trying to become centralized. In other words, they need the underwriting of Wall Street.
Mm-hmm.
But once you have the underwriting of Wall Street, they know who you are. They know your address, your social security number. They can take your blockchain, your currency from you. They can arrest you if they wanted to. In fact, a lot of times you see what happens is when these Bitcoins are used for ransom, the FBI finds out, they look at the blockchain, they see the transaction, they find out who you are, and they take your coins back. They take the coin back, your private key. It's no longer yours. So a coin that wants to be decentralized as its only value, otherwise it's a glorified barcode. Its only value is riding anonymously along this blockchain. And then they say, okay, well, now I want Wall Street's blessing. Well, when they do that, all of the value of it goes away. So count me out when it comes to cryptocurrencies. And I'll say this, guess what? I've been dead wrong about the price. I mean,
haven't we all?
Dead wrong. So no, I was right in 2017 when I believe that was when it went from like 10,000 to 3,000. I got that one right, but I still said to get out of it. And then it went from 3,000 to 65. So this is, I believe it's indicative of the everything bubble. And I think you said it, and you're correct. Systemic risk. What happens if these coins actually, the Fed comes in next year, ends the taper, starts raising interest rates, the dollar gets even stronger, puts more fear into the cryptocurrency and et al, Ethereum and Litecoin, all the rest. And these things crash. Is there systemic risk there? I mean, how much of Wall Street hangs in the balance, and the shadow banking system hangs in the balance of this market that's now, over $1 trillion. So
yeah,
it's part of the systemic risk, and I think it could be in a lot of trouble next year.
No, I agree with you. Is there anything you'd like my audience to know?
There's a lot of things I'd like them to know. You can contact me directly at mpento@pentoport.com. The phone number for the office is 732-772-9500. The website is pentoport.com. I'll leave you with this. The corporate bond market. So it took from World War II to 2010 to accumulate $6 trillion of business debt. In the last 10 years, we added another $6 trillion to that debt. And it's the riskiest kind of debt. It's either barely investment grade or junk, most of that debt. And when the next crisis comes, there's an air pocket there. So when there's no more issuance and the credit markets freeze, you look for these bond prices to just plunge, and all of the investment grade, barely investment grade, will become junk. Fallen angels, they call them. That's going to be a cataclysm for the stock market. And that this all could happen. I'm not a Cassandra. I'm just saying the odds of it happening are very elevated because of the distortions created by years upon years of ZERP and QE.
Well, you look at the long-term charts of all the major indices, and like the monthly charts, and they just like they're headed steep, ready to just dive off a cliff.
Margin debt,
Yeah.
nominally and as a percentage of GDP, all-time record high.
Oh, I saw that chart last week. It was crazy.
Inflows to equities. In the biggest inflow of equities this year than in the past 19 years combined. Doesn't that scare? It scares the heck out of me. And I feel it viscerally with the people that are calling me, that are coming on board, say, hey, listen, I no longer, I've worked hard my whole life. I've saved several $1 million to retire. I want to be able to stay ahead of inflation if I can, because it's running at close to 7%, the way the Fed calculates it and the BLS calculates it. So I can't just sit in the bank, but I also want to be able to profit from any potential crash. And then also, just as importantly, Lee, be able to buy at the nadir of the next crash. Because in the next 10 years, I believe in the next 10 years, the average return is going to be like minus 2%. This is back tested factual mathematical data based on the overvaluation of stocks. So minus 2%, and you're not going to have minus 2, minus 2, minus 2, minus 2. It's going to be something like minus 50, minus 80, and then up 50, up 60, up set. So that's the kind of dynamic move you have to at least try to capture. And you won't get that at your typical wirehouse who'll say, hey, don't worry, the Fed put is still in place. Just buy and hold stocks.
Michael, thank you so much for your time. I really appreciate it. And the kind words before, very, very nice. Appreciate it.
Well, I meant them. I really meant them. And I wish you a lot of blessings on your program and much success in the new year.
Thank you, Michael.